In this video, I'm going to share with you a little bit about how covered calls work, right? The workflow and the processing that occurs whenever I sell an option contract. And then I'm going to spend a little bit of time explaining how I'm able to generate either a weekly or monthly income by selling these covered call option contracts. So I received a couple of comments on some of my videos over on my YouTube channel from viewers asking me if I could explain how I'm able to generate an income using covered call option contracts. So in this video, I'll explain how, by selling a covered call option contract, I can generate an income whether the option contract get exercised, or I can still generate an income if the option contract expires worthless. And just as a quick reminder, this video is for education and entertainment purposes only. And for goodness sake, don't execute the same trade I'm showing in this video. It's just an example. So let's talk about selling a covered call. It's one of the best strategies I know of to generate an income. Now on a difficulty scale of 1 to 5, this has got to be easily a 1 because it is so simple and easy to execute this strategy and generate an income. Now the prerequisite is you must own or control 100 shares of stock, and the stock must be optionable. But other than that, once you have that, you're good to go. So now let me walk you through a scenario of selling a covered call so you can see how I'm able to generate an income whether the option contract gets exercised or the option contract expires worthless. Have you joined my free option trader user community yet? It's where option traders like you and I share information plus tips, tricks, hints, and secrets about option trading. This community also has access to a classroom with lots of helpful information and classes. This is a free user community where stock traders like us get together and learn about simple option trading and use it to generate a regular weekly or monthly income. It's free to join and participate. Hey, did I mention it's free to join and participate? So head on over to school.com/simpleoptiontrading. I'll leave a link in the description down below. So now let's take a look at a daily chart for Flagstar Financial Incorporated, symbol FLG. As I mentioned, this is a daily chart going back to March of 2025. And if we look at the candlestick pattern here, we see that the price is ranging mostly be in between a support line right around $10.97 and a resistance of $12.51. So as the price approaches the support line, it bounces off of there, comes up, reaches the resistance, and then comes back down. And you can see this pattern repeating over and over, right? So as it approaches support, bounces up, hits resistance, comes back down, hits support, comes back up, hits resistance, and comes back down. Now I've drawn a secondary support line. So in looks like the middle of April, we can see that the price actually dropped to right around just under $10, $9.93. Topped out right around that. You can see that it topped out right at the support line. So that's something to note. As a price dips below, say, a support line, that support line now becomes a resistance line. So when it's trading in this area, but it broke above near the third or fourth week of April. And then you can see as it continues, we've been seeing largely for this time period that this stock is what's called range trading in between the support and resistance. And so that's $10.97 and $12.51. We like to see a pattern like this because it can be predictive of what the stock will do. Now, obviously, there's no guarantee, but we see that the market in general doesn't like to see the price dip below the $10.97. And so there's it's see that the stock is sold off, and so there's some buying that occurs. The market at large sees that as a good price point to start buying or accumulating the stock. And then likewise, when the stock reaches that $12.51 range, you see some sell-off and some consolidation as the owners of the shares start to sell off their shares, taking profit off the table. So here we could see me on the left, and on the right we see representation of the stock market filled with buyers. So for this scenario, I'm going to be using shares of Flag Financial, symbol FLG. And for this example, let's say I own 100 shares of the stock and I purchased them for $11.50 per share. So that's my cost basis. And now I've decided I want to use those shares as collateral in order to sell a covered call option contract. So I'm going to set the strike price at $12.50. Remember, that was the upper resistance line. And I'm thinking that the market price will reach that level and probably drop down, but it may go just above that. But if it does go above, it's not going to go very much. So I really like picking that $12.50 strike price. And I'm going to use an expiration date of January 20th of 2026. Now, once I decide to sell the option contract, I'm going to make it available to the market at large. And anybody that's interested would indicate so by submitting the premium premium payment to me, and in return, they would receive the option contract. So that's a binding contract between the buyer and myself. So now let's take a look at the two different outcomes that can occur. Outcome number one is where the buyer decides to exercise the option. And in general, the condition is this. It's when the market price is greater than the strike price on or before the expiration date. So let's think about that. So let's say that the market price is $13 on the expiration date. Well, in that case, the buyer, he could buy my shares for $12.50 by exercising the option contract, and then he can immediately turn around and sell those shares for $13 per share. And he could capture that difference, that 50 cents per share. That's an immediate profit for that particular buyer. So in every case where the market price is above the strike price, the buyer will execute the option contract because it's an advantage for them. Now, when the buyer executes that option contract, they're going to end up paying me for my shares, and I'm going to give those 100 shares of FLG over to the buyer. And that's called having my shares assigned. So my shares get assigned to the buyer, and in return, I receive payment for my shares at the strike price value. So in this case, it was $12.50. So at $12.50 times the 100 shares, I would receive a payment of $1,250. Now recall, my purchase price or my cost basis was $11.50 per share. So the difference between what I paid, the $1,150, and the amount that I received from the buyer executing the option, $1,250, that $100 difference, that's my profit that I get to keep. So that's profit to me for selling those shares, and that's the price appreciation profit. Now, in addition to that, I've also received the premium payment up front. You remember when I initially sold the option contract. So I'm getting two incomes by selling this covered call option contract in this particular scenario. So it's the premium payment plus the price appreciation that I received when my shares got assigned. Now let's take a look at outcome number two, and this is where the option contract expires. So in this particular case, on the expiration date, the market price finishes below the strike price. And if we think about it, there's no reason for the buyer to execute the option contract if they can just go out to the general market and buy the shares themselves for less. So in this particular case, the option expires worthless, and the benefit to me is that I get to keep my 100 shares of stock. Remember, they're not assigned. The option contract has gone away, so I keep my original shares. Plus, I keep the original premium payment that I received at the beginning when I sold the option contract. So I hope this video has been helpful, and you have an understanding of how I'm able to generate an income by selling a covered call option contract. So number one, I collect the premium payment just by selling the option contract itself. But if the option contract gets exercised, that means my shares will get assigned to the buyer, but in return, I'll receive payment for those shares at the amount specified by the strike price. Or if the option contract expires worthless, I still keep the premium payment and I still keep my shares, meaning I can go out and sell another covered call option contract using those same exact shares. And as long as my shares don't get assigned, I can keep doing this over and over and over again, collecting premium payments along the way for each option contract that I sell. Don't forget to join my option trading community. Did I mention that it's free? Head on over to school.com/simpleoptiontrading. I'll leave a link in the description. I hope to see you over there, and I also hope to see you in the next video.